Cancellation of debt, or COD income, is usually taxable because you got money or value and didn't pay it back. That's why Form 1099-C shows up and scares people. But the EA exam loves the big exceptions. Your job is to spot when COD is excluded, how much is excluded, and when Form 982 is required to claim it. Start with insolvency. You're insolvent when, immediately before the debt is canceled, your total liabilities exceed the fair market value of your total assets. And assets is broad. On the exam, they'll sneak in retirement accounts, like IRAs and pensions. The key limit: you can exclude COD income only up to the amount you're insolvent. Here's the calculation pattern. Step 1. Compute insolvency amount, liabilities minus FMV of assets. Step 2. Compare that to the canceled debt. The exclusion is the smaller of those two numbers. If COD is bigger than insolvency, the extra is taxable. Exam tip: the timing phrase immediately before the discharge is not optional. Bankruptcy is the cleaner rule. If the debt is discharged in a Title 11 bankruptcy case, the COD income is excluded. But you usually don't just ignore it. You report the exclusion and any required tax attribute reductions on Form 982. On the EA exam, if you see discharged in bankruptcy, your brain should immediately say exclusion plus Form 982. Next is qualified principal residence indebtedness, QPRI. This is mortgage debt secured by your main home, used to buy, build, or substantially improve it. It can also include qualifying refinance debt. It applies to restructurings, foreclosures, and short sales, but only for a principal residence, not a vacation home or rental. And you generally use Form 982 to claim it. Watch the dollar limit. For discharges in 2021 and later years, the max QPRI exclusion is $750,000, or $375,000 if married filing separately. This extension runs through 2025. On the EA exam, they'll test both the main home requirement and the post-2020 lower cap. Student loans get a special temporary break. Under ARPA, most student loan forgiveness is excluded from income through tax year 2025. That includes federal loans and certain private or institutional loans. Lenders generally shouldn't issue a 1099-C for qualifying discharges. Exam tip: if the fact pattern is 2026, don't assume this exclusion still applies. Last one, cancel debt that would have been deductible anyway. If you're a cash method taxpayer and a payable gets forgiven, you don't pick up COD income if paying it would have created a deduction. Classic example: a business expense billed on credit, later forgiven. If it would have been deductible when paid, the forgiveness doesn't create taxable income. Omar had $8,000 of credit card debt canceled, and he got a Form 1099-C for $8,000. Right before the cancellation, his total liabilities were $17,000, and the fair market value of his total assets was $6,000. Which statement is correct? Options include reporting the full COD income, excluding some amount, or excluding all of it due to insolvency. Think about it. He can exclude the full $8,000 because he's insolvent. His insolvency amount is $11,000, $17,000 of liabilities, minus $6,000 of assets. The insolvency exclusion lets you exclude COD up to that insolvency amount, so all $8,000 is covered. A tempting wrong choice is excluding $11,000, but you can't exclude more than the COD you actually have. Marissa had $5,000 of credit card debt canceled and received a 1099-C for $5,000. Immediately before the cancellation, her total liabilities were $15,000 and her assets had a fair market value of $7,000. How much of the canceled debt is taxable? The choices range from all of it to none of it. Think about it. None of it is taxable. She's insolvent by $8,000, $15,000 minus $7,000. Since the canceled debt is only $5,000, it's fully excluded under the insolvency rule, typically claimed on Form 982. A common trap is picking $8,000 or $7,000, but those numbers aren't the canceled debt amount.